Tommy stared at his phone and smiled. His retirement account had just crossed $64,000. Across town, Carter checked his own balance. $46,000. Same age, same salary, same number of years investing. Yet Tommy was ahead by almost $18,000. The verdict seemed obvious. His coworkers thought so. His family thought so. Even most financial headlines would agree. But 30 years later, Tommy would discover something that almost nobody tells you when you're staring at a growing retirement account. Sometimes the biggest balance on the screen doesn't belong entirely to you. Hey, I'm Brian, and I spend way too much time thinking about how taxes quietly change the outcome of almost every money decision you'll ever make. Today, we're breaking down the real math behind the 401(k) versus the Roth IRA, why one account looks unbeatable for decades, and why the answer isn't nearly as obvious as most people think. If you enjoy finance explained through stories and actual numbers, you're in the right place. Smash that subscribe button. Meet Tommy and Carter. They're both 30 years old. Both live in the same city. Both earn $75,000 per year. Both want the same thing: a comfortable retirement where money isn't a source of stress. Neither is reckless. Neither is a financial genius. They're just two professionals trying to make smart decisions with the information they have. And for the next 32 years, they'll invest consistently. The difference comes down to one choice. Tommy prioritizes his employer-sponsored 401(k). Carter prioritizes his Roth IRA. At first, Tommy looks like the obvious winner. His employer offers a 4% match. That's free money. His contributions also reduce his taxable income. That means a smaller tax bill every year. People love this strategy. His coworkers tell him he's doing exactly what every responsible adult should do. When retirement comes up at lunch, Tommy gets approving nods. You'd be crazy not to take the tax deduction. That's literally free money. Why would anyone turn that down? Meanwhile, Carter quietly sends money into a Roth IRA. No immediate tax break, no applause, no visible reward on payday. To most people, it looks like he's choosing the harder path. And for the first few years, it really does look that way. Let's run the numbers. Both investments grow at a reasonable 7% annually. Tommy contributes $7,500 per year to his 401(k). His employer adds another $3,000 annually through the match. That means $10,500 enters Tommy's account every year. Carter contributes the same $7,500, but receives no employer contribution. Year 1 arrives. Tommy's account ends the year at roughly $11,200. Carter finishes with roughly $8,000. Not a huge difference yet, but the gap has started. By year 3, Tommy's balance climbs to approximately $36,000. Carter sits closer to $26,000. Tommy now leads by around $10,000, and that's before considering taxes. Because every year Tommy contributes to his 401(k), his taxable income falls. Assuming a combined marginal tax rate around 22%, his contribution saves him roughly $1,650 annually in taxes. Think about that. Tommy gets more money invested. Free employer money. A lower tax bill. It's a triple win. By year 5, the difference becomes impossible to ignore. Tommy's account reaches roughly $64,000. Carter's sits near $46,000. That's a lead of almost $18,000. Even their monthly cash flow tells the same story. Tommy sees immediate tax savings every paycheck. His retirement strategy feels rewarded right now. Carter pays taxes today. Tommy postpones them. Most people stop the analysis right there. Bigger account, lower taxes, free employer match, case closed. But hidden inside Tommy's growing balance is a cost that hasn't shown up yet. A cost gets larger every single year, and the longer nobody talks about it, the bigger the surprise becomes. If you're new here and just subscribed, comment your name below. I read every comment and shout out new subscribers in my next video. I do appreciate you joining me on this finance journey. Imagine buying a house with a silent business partner. You pay for the maintenance. You take care of the property. You watch it increase in value for decades, but your partner owns a percentage of the future sale, and they never let you forget it. That's essentially how a traditional 401 works. The tax deduction feels like a gift, but it isn't a gift. It's a postponement. The government isn't saying, you never owe this tax. It's saying, we'll collect it later. Every dollar Tommy withdraws in retirement will be treated as ordinary income. Not just the growth, not just the gains, every dollar. That creates an ongoing risk. The first risk is simple. Future tax rates are unknown. Tommy assumes he'll pay less later. Maybe he's right. Maybe he isn't. But he's making a 30-year bet on future tax policy. That's a bigger assumption than most people realize. Now let's talk about a more serious problem. At age 73, Current rules require many traditional retirement account holders to begin taking required minimum distributions. In plain English, the government eventually says, "You've delayed taxes long enough. Start withdrawing money." Whether Tommy wants the income or not becomes irrelevant. The withdrawals become mandatory, and those withdrawals can push retirees into higher tax brackets. But there's another layer, one that's rarely discussed. Large retirement withdrawals can cause a greater portion of Social Security benefits to become taxable. In some cases, up to 85% of those benefits can be exposed to federal taxation. So one tax bill can trigger another, like a row of dominoes. One falls, then another, then another. The irony is that the account that looked most efficient during working years can become less efficient during retirement, not because the investments performed poorly, but because taxes finally entered the chat. And this is the crucial mental shift. When Tommy sees $100,000 inside a 401a, that isn't necessarily $100,000 he can spend. Part of that balance belongs to a future tax bill. The exact amount isn't visible, but it's there, growing quietly beside the account itself. Which is why the most important sentence in this entire discussion might be this: the number Tommy sees on his statement isn't his number. Now here's where many financial videos become dishonest. They expose the weakness of one strategy and immediately declare the other the winner. Reality is messier than that, because Tommy's strategy has some very real advantages, and ignoring them would be a mistake. First, the employer match is enormously valuable. If someone offers to contribute money simply because you're contributing money, that's difficult to beat. A 4% match on a $75,000 salary means an extra $3,000 per year entering the account. That's real wealth, not theory, not projections, actual money. Second, Tommy receives immediate tax relief. That reduction in taxable income creates extra breathing room in his budget today. For families juggling mortgages, childcare, and rising costs, that flexibility matters. Third, 401n plans allow substantially larger annual contributions than Roth IRAs. High earners who want to save aggressively may simply need that extra contribution capacity. A Roth IRA alone may not be enough. And yes, there are situations where Carter genuinely loses. If Tommy retires in a significantly lower tax bracket than he had during his working years, the tax deferral becomes extremely powerful. In that world, Tommy delayed taxes when rates were high and paid them when rates were low. That's exactly what the strategy is designed to do. Meanwhile, Carter made a different trade. He accepted pain today in exchange for certainty tomorrow. He paid taxes up front, no deduction, no immediate reward, no applause from coworkers. But he purchased something valuable: predictability. He knows exactly what percentage of his retirement account belongs to him. 100%. No future tax calculation required, no guessing, no surprises. So at this point in the story, we still don't have a winner. Tommy has a larger account. Carter has a cleaner account. Tommy gained leverage from tax deferral. Carter gained freedom from future taxation. And over the next 3 decades, those two advantages are about to collide in a way that completely changes the scoreboard. Fast forward. The meetings are over. The promotions happened. The kids grew up. The mortgages got paid down. And Tommy and Carter are now 62 years old. For 32 years, both stayed consistent. No market timing, no stock picking, no financial wizardry, just disciplined investing. On paper, Tommy looks unstoppable. His 401n balance has grown to approximately $1,238,000. Carter's Roth IRA sits at approximately $885,000. At first glance, the comparison seems over. Tommy is ahead by more than $350,000. That's not a small difference. That's the kind of gap that makes one strategy look superior. And if all you ever look at is the account balance, Tommy wins by a landslide. But retirement doesn't happen on paper. Retirement happens in real life. And in real life, people don't spend account balances. They spend after-tax dollars. Let's assume both men want to withdraw $60,000 per year to support their retirement lifestyle. When Tommy pulls money from his traditional 401n, those withdrawals count as taxable income. After deductions and federal taxes, he ends up paying roughly $5,100 annually in federal taxes. Every year, year after year, Carter withdraws the same amount from his Roth IRA. His withdrawals are tax-free. No federal tax bill, no surprise tax forms, no portion carved out for the government. The money arrives exactly as expected. Now stretch that over a 25-year retirement. Tommy's cumulative federal tax bill approaches $188,000. Carter's remains close to zero. Read that again. Tommy built the larger account but also inherited the larger tax obligation. And this is the brain-breaking part. A lead of more than $350,000 on paper shrinks dramatically once you start counting what Tommy actually gets to keep. The scoreboard everyone watches for 30 years isn't measuring spendable wealth. It's measuring gross wealth. And those are not the same thing. By retirement, Tommy still has a larger nest egg. That's true. But Carter owns every dollar inside his account outright. No future tax calculation. No required minimum distribution concerns. No wondering what Congress might do to tax rates 20 years from now. Just money. Ready to be used. The lesson isn't that Tommy failed. Far from it. The lesson is that the gap between them is much smaller than most people think. Because one account reports pre-tax wealth. The other reports after-tax wealth. And those are two very different scoreboards. Now let's rewind. Tommy and Carter are 50. Retirement is still years away. Life is moving normally. Then reality interrupts. A sudden family emergency creates an immediate need for $30,000. No warning. No time to plan. Just a bill that has to be paid. This is where retirement accounts stop being spreadsheets and start becoming real life. Tommy looks at his 401k. The money is there. But accessing it comes with consequences. Because he's under retirement age, an early withdrawal can trigger taxes and penalties. To get the $30,000 he actually needs, he may end up losing roughly $9,600 to taxes and penalties. Money disappears before it ever reaches his bank account. What looked like $30,000 of available savings turns into closer to $20,400 after the damage is done. Carter faces the exact same emergency, the exact same amount, the exact same stress. But Roth IRA rules allow him to withdraw his original contributions tax-free and penalty-free. Not the investment gains, the contributions. Money he already paid taxes on years ago. So Carter accesses the full $30,000. No penalty, no tax surprise, no emergency surcharge. Neither man wanted this situation. Neither planned for it. That's the point. The most important financial decisions are often judged not by what happens when everything goes right, but by what happens when life goes wrong. And in this scenario, the quieter account turns out to be the more flexible one. So after all of this, what should someone actually do? The answer is not choosing Team Tommy or Team Carter. The answer is understanding the order of operations. Step 1. Contribute enough to your 401k to capture the full employer match. If your employer offers a 4% match, get the entire 4% always. That match is one of the closest things in personal finance to free money. Walking away from it is usually walking away from part of your compensation. Step 2. Max out your Roth IRA. For many workers, that means contributing up to the annual Roth IRA limit. You are buying decades of tax-free growth and tax-free retirement withdrawals. You're also creating flexibility for future emergencies and reducing your exposure to future tax rate uncertainty. Step 3. Return to the 401k. Once the match is secured and the Roth IRA is funded, direct additional retirement savings back into the 401k. This allows you to take advantage of larger contribution limits while still maintaining tax diversification. And that word matters. Diversification. Not just diversification of investments. Diversification of tax treatment. Who should lean more heavily toward a 401k? Typically someone in their 40s or 50s earning a higher income, especially if they expect their retirement tax bracket to be lower than their working years bracket. Who should lean more heavily toward a Roth IRA? Often someone between their 20s and late 30s earning a moderate income who expects higher earnings and potentially higher tax rates in the future. But the strongest strategy isn't usually choosing one. It's combining both. Tommy wasn't wrong. Carter wasn't wrong. They were each solving a different problem. The smartest investors build systems that benefit from both approaches at the same time. Think back to the beginning. Two people, same age, same salary, same goal. One account looked bigger almost every year. The crowd saw the larger balance and assumed the answer was obvious. Most people still do. But wealth isn't measured by what shows up on a statement. It's measured by what remains after taxes, after rules, after reality, and after life gets involved. So the next time someone tells you a 401k always wins, ask them one question. Did you include everything?